there were inadequate segregation of duties, and she was in charge of running the payroll and reconciling the payroll to the bank. And she just created ghost employees, or when employees termed, she just redirected their bank information to her own account, and nobody noticed until she went on vacation. And I remember my boss telling me that she would have nightmares. I mean, she was traumatized by this. She had nightmares for over a year about this woman. It was terrible.
Growing a business requires a holistic approach that extends beyond sales and marketing. This approach needs alignment among people, processes, and technologies. So if you're a business owner, operations, or finance leader looking to learn growth strategies from your peers and competitors, you're tuned into the right podcast. Welcome to the WBS Podcast, where scalable growth using business systems is our number one priority. Now, here is your host, Sam Gupta.
Hey everyone, welcome back to another episode of the WBS Podcast. I'm Sam Gupta, your host and principal consultant at independent ERP and digital transformation consulting firm Elevate IQ. How hard could managing your business bank accounts be? Just run your EFT, receive your statements, and match your transactions, right? Well, bank account management could get extremely nuanced as well. For example, if you are not set up for positive pay, your accounts could get locked down for several days. Sure, you'll get your money back if you have had a fraudulent transactions, but the money might not be available for months. So what do you need to know to manage your bank accounts? In today's episode, we invited a panel of cross-functional experts for a live interview on LinkedIn who brings significant expertise to discuss bank account management best practices. We discussed bank account management concepts such as the right mix of chart of accounts for each bank accounts, the importance of subledgers, and the challenges during audit without the processes for cash hygiene. Finally, we discussed horror stories covering concepts such as disappearing of cash and using ghost employees to reconcile the bank accounts. With that, let's get to the conversation. Hello, everyone. Welcome to today's show. And if you are joining for the first time, this is part of our digital transformation series for which we meet every Thursday at 5:30 p.m. Eastern. We pick one topic related to digital transformation. For today, we have a very deep and interesting topic, and some people might be wondering, what the hell are we going to be talking about today for an hour? This is about bank management, and then you are going to realize, okay, how nuanced it could get when you are going to be managing your bank account processes. So we are going to have a lot of fun discussing that. Before we do that, we are going to start with everybody's intros. If you don't know me, I am your host, Sam Gupta, principal at Elevate IQ. Elevate IQ is the independent ERP and digital transformation consulting firm. On that note, I am going to move to Chris for his intro.
Thanks, Sam. I'm Chris Ghiardini, the CEO and owner of Turnkey Technologies. We're a 28-year-old Microsoft Dynamics partner organization. So myself, I've been implementing ERP solutions since the 80s. I think I got everybody on that one. And so banking is at the center of everything, right? Because it's the money, it's the vault. So looking forward to the conversation.
It is really the center of everything. Thank you so much, Chris, for being here. Ben, can I ask you to introduce yourself next?
Yeah, absolutely. Thanks for having me again, Sam. Ben Cole here, president at ERP Connect Consulting. Like Chris, we implement Dynamics products as well, specifically D365 Business Central. So excited to talk about how the bank plays into that. And again, like Chris said, how it's the vault and how everything revolves around it. I think our last presentation was about cash flow management. So we'll take some pointers off that as well. Thanks, Sam.
Love it. Thank you so much, Ben, for being here. Matt, can I ask you to introduce yourself next?
Hey, everyone. Matt Bernat. I am the lead business analyst for Miles Technologies and our ERP Striven. Before I did that, I've been doing this for about 3 years. But before that, spent 4.5 years as a banker. So I'm going to be coming at this from both sides, the banker side and the ERP side.
And I am going to like both of those sides. Thank you so much, Matt, for being here. Sharon, can I ask you to introduce yourself next?
Glad to be here, Sam. Thank you for having me. Good to see everyone here. I am Sharon Custer. I'm an inventory optimization consultant, and I help people, especially e-commerce owners, to do inventory data analysis, cash flow forecasting, and financial analysis. And I was in wholesale business and manufacturing business before, and I do international trade. So I know how difficult that the cash flow can be and manage the bank account.
Okay, amazing. And today we are going to be optimizing their bank. So thank you so much for being here, Sharon. Rachel, joining for the first time, can I ask you to introduce yourself next?
Thanks, Sam. Thanks so much for having me. Hi, everyone. My name is Rachel Capel. I work with Aventus Advisory Group. We are an outsourced fractional CFO services company. We provide strategic advisory and other controllership-related services. I specifically focus as a director at Aventus on financial controls and governance, and my background is in a varied range of accounting and controllership functions, most recently controls specifically related to the banking industry. So I've been in banking before I joined Aventus for about 8 years. So cash controls and banking is something that I live in, looking at it through the controls lens every day.
This is going to be so much fun. Thank you so much for joining, Rachel. And if you're in the audience and joining for the first time, make sure you guys post your questions and comments. We typically try to cover them during the show. If we run out of time, we'll make sure that you receive your answers. On that note, I am going to start with Chris with the first question. And this is really going to be, okay, let's say if we sort of draw the boundary of the bank account process when it comes to managing these bank accounts and interacting with those accounts, and how the vendor and the customer side of processes are going to be overall, whether you look at the finance department, accounting department, or the ERP system. So Chris, over to you.
Sure, Sam, thanks. Bank account management, it's a big topic. That you heard me say the word vault. It's very close to my heart because money, right? We want to control money. But as you think about processes and speaking kind of agnostically, because I've worked with a lot of different, but if you just look at, what's the word I wrote down? Control, right? I want to control that thing. And, the control is, I don't want to lose money. I don't want to over-report the money. I want the money to equal what should be there. But as we think about what surrounds that, we think about the bank account. We think about most systems set up a bank account relationship to a bank. And a bank account has a relationship to a general ledger cash account. So if we talk about just the landscape of financial balance sheet, cash, GL account to a bank account, there is a relationship. Okay, so some of the no-nos, you don't do journal entries where you make adjustments directly to the general ledger account that represents cash. You have to make transactions in best practices. They should flow through subledgers. Unless you don't have subledgers, you just integrate data, and that's a different scenario. But if you think about a receivable subledger, and you think about banking and bank account management through there, payment processing, you're taking monies, you're taking deposits, you got credit cards, you got wires hitting, you got EFTs hitting, mixed currencies maybe. So again, if you think about inflows, and inflows can come from AP as well if you get reads or credits, but typically your cash is coming into a receivables ledger, or there's non-AR cash that shows up if you've got other funding. But those transactions typically route through a subledger and end up heading towards the bank and cash management module where it accumulates for the bank reconciliation, right? So all those transactions, they hit a general ledger and they're hitting a banking module. And again, hopefully in unison, hopefully the bank account says and it matches your ledger info. And on the AP side, again, this is how money's flowing out of the business, right? Wires, ACHs, checks. So again, you're thinking inflows, everybody says, I don't need a lot of security. Bring the cash in the door, but going out, tighten it up, right? We don't want to let money move, but then controls, safe pay. What does that mean? You send a bank a list of your checks, so it's a double verification, forging, frauding checks. You got wires. Then you go back to how do you authorize? What's the method? Domestic wires, international wires, a lot of manual processes surrounding that. I know I have a subsidiary corp in Mexico, and I'm moving pesos, not dollars, pesos. So am I buying pesos in the U.S. and then moving dollars? Well, that's an interesting transaction. How do I book that into my back office? Next topic. But again, foreign exchange transfers, wires, all these outflows, control. Do people sign, or do we have security that does this and this? And then what's the key to unlock the check signer? Maybe we use an external check signer for more security. But again, security, we go to the nth degree is how people authenticate. So that's part of this as well, is how does it, again, do they have a fob or something that plugs into it's different today, it's virtual, right? So again, complexities around security. I mentioned reconciliation. So again, this is the imperative of, hey, did people cash the checks? Where are the checks? There's if we're using paper checks, EFTs, wires, again, reconciliations, inflows. Am I making deposits? Am I reconciling deposits to the bank statement? Credit cards. delays, timing, undeposited funds, how we tracking all that. There's special utilities even for credit card reconciliations. So as you get into e-commerce, there's a lot going on the movements of cash. When does it settle? When do we recognize it? So again, I mentioned a lot of pieces. I think there's more. We talk about sweep accounts. I'm not from banking, so I'll defer to some banking people to talk about why you would do that. But it creates more transactions. If you think about how do we book all these entries? I didn't mention integration. So banking integration, when you set up banking profiles, now we have mechanisms today. 10 years ago, you wanted to e-reconcile. Everybody's like, I'll send you a PDF, and you're trying to get an electronic feed. Maturity in banks has come a long way. Most of your banking partners, you got to ask them, hey, what can I communicate electronically? How do we keep our hands off of this stuff? That's also security as well as you eliminate. I'll stop there.
Okay, amazing insights there. And by the way, I love the way you are using the term vault. And hopefully, Matt can teach me how to get access to Chris's vault, because obviously he's hiding like billions of dollars there. And obviously, we want Matt to touch on the sweep account as well. But Chris, I am going to have one follow-up question for you. And you emphasize on the term subledger. And I'm pretty sure Ben is going to talk about subledger as well. He has already spoken about it, how strongly he feels about these subledgers. But now buddies, who are doing accounting, let's say in QuickBooks or spreadsheets, what is a subledger? They don't know it. Let's just do negative accounting, right?
QuickBooks has receivables. That's supposed to post cash through the customer ledger to the customer account if you've got receivables versus doing a journal entry. Or again, most banking modules have a transaction entry. You can book through a banking module, and banking is a subledger module to the general ledger. So again, versus us doing journal entries against cash accounts and then come back and say, how do you recognize it? The bank says it's got this and the GL says this. But again, the bank module is a subledger as well. So most QuickBooks, they still, even the primitive ones, have what we call. But again, what the discipline is don't be doing journal entries hitting your cash account. You'd have to ask yourself, why am I doing that? Because again, we get a variance between the subledgers and the general ledger in that kind.
Yeah, and we are going to, ask this, from real CFOs and the accountants, whether real they CFOs. Feel, how they feel about this one. ERP people are always trying to overcomplicate things, right, Chris?
Automate business process, put the controls in here so we manage exceptions, not touch everything that walks in there.
Okay, amazing. Thank you so much, Chris, for that. So Ben, I'm actually coming to you. So from your perspective, let's say if you look at the bank account, and obviously you feel very strongly about subledgers as well. So I don't know if you're going to have any sort of layers there, but do you want to describe the process boundaries and any sort of interactions that you have seen in the industries that you work in?
Yeah, definitely. So, that was the first place I was going to start before you prompted the question to Chris, right? I think a lot of times people will call me, right, as the first thing, like, hey, we're just trying to get our month end done and we can't reconcile like anything. And my first question is kind of like, why can't you reconcile the bank? Like, to me, the bank should be the easiest thing to reconcile. You look at your bank statement, you look at your subledger, and you start checking the boxes or use an e-reconcile, like Chris said. A lot of different ways to get to the end result, but at the end of the day, it shouldn't be hard, right? Like, I run my own business, I reconcile my own bank, it takes me 5 minutes a month. Why doesn't it take that long for everybody else? Because people are posting directly to cash. People are doing all these funky things that you really shouldn't do. So again, kind of digressing all the way back to the first time you set up the system and how you define your processes and things like that. There's a lot of checks and balances you can keep in your system. I know in the system I use specifically, there's one thing on every chart of account. It says, do you want a direct post to this or not? If you say no, you can literally never hit the cash account without running it through a subledger, in this case, the bank, right? So that forces me to keep those things in check. So a lot of times if we're implementing, I'll call that out to the client. We'll make sure that's off, and then they can literally never post to the cash account directly, which is going to make the reconciliation a lot easier at the end of the month. If you do have weird processes where the client just says, Ben, like, I absolutely can't follow your rules and I'm the client, so I'm going to do whatever I want. And I'm going to say, okay, that's fine. At the end of the day, it's all your choice. Whatever you want to do, don't advise it, but let's go that direction, right? Keeping up on your reconciliations. Because a lot of times what I find is somebody will be like, I haven't reconciled since June. You haven't reconciled your bank since June? How do you even know what you have in your system is accurate right now? So taking a more proactive approach rather than a reactive. And I think a lot of times when, I unfortunately get hired at the point where it's a reactive, and then we convince them, obviously, hey, you just spent all this money to fix things. This is how much it would cost to do it right every single month. And if they're good with it, then, you can build a well-defined process. And for those joining the call today that didn't listen last week, we had a really good conversation on cash flow, and I'd suggest checking that out on Sam's YouTube channel. But goes back to, kind of downstream effects, right? If you want to run a cash flow statement, you got to manage your bank correctly. If you want to do a lot of these things, you need to have a lot of the setups in place from the get-go. Otherwise, none of your reports are going to be accurate, and it's going to be hard to run a bank ledger or anything out of your system if cash is hitting a GL account. It's not going to show up in your bank subledger. So now all of a sudden, you don't have any visibility into it. So I think kind of coming off of those pieces, subledger, reconciliation, keep up, were kind of the two main things I wanted to talk about. But then the last thing, again, kind of piggybacking off of what Chris had said, try to automate as much as you can. There's a lot of good tools out there today that can, number one, bring the transactions in for the first time from the bank and do things like auto match, customer payments to invoices and make sure those invoices are fully closed out. So it affects your AR subledger as well, right? We're getting multiple subledgers being touched at once now. But there's a lot of things at play. You can bring a lot of things in automatically from banks out of box for free. Even with tools, I don't like QuickBooks, but even with tools like QuickBooks, they even have banking integrations, right? And of course, your NetSuites and Intax and Dynamics tools, they're all going to have a lot of these cool banking integrations that are going to save you time. And I love saving my clients time. So anything that you can do to automate, I would highly encourage and highly recommend. So that's my 2 cents. Sam, I don't know if you have any follow-up questions on our initial piece, but I figured you knew where I was going with that one based on your prompt.
Yeah, so great insights there. And obviously, I'm going to have some follow-up question for you as well. Yeah. And this is going to be in line with some of the comments that I read when I am dealing with anybody who's coming either from a spreadsheet or QuickBooks, okay? For them, obviously, it's going to be a huge transition utilizing these flows, and sometimes they don't understand why you have to have so much control. Okay, why can't we make things easier? And you mentioned that, you should never be operating on the cash account directly. So maybe provide an example of what are going to be the implications. Let's say if you are operating on that versus utilizing a subledger. Do you have any sort of example or story there, Ben?
Yeah, I mean, going back to the first thing we talked about, the bank rec, right? You physically can't do a bank rec in any ERP system if you don't have all of the activity in the banking subledger, right? So what we had talked about originally is that general ledger kind of sits at the very top, and all the sub accounts, all the subledger sits below it. So everything's going to flow up to the general ledger at the end of the day. But first, you got to put things in AR and AP in the bank and all that. They're eventually all going to flow up to the general ledger. But basically, think of it as skipping a step, right? If I skip a step where I forget to do something, now it's not going to flow up to its final destination, right? So if you just skip the banking piece completely, sure, it might make it in your financials in the correct spot, but you're skipping a step. So now those two things don't tie out, right? It's kind of a balancing act. You can't do it in one place and not do it in the other if you want everything to tie out at the day. Your cash account, and again, I didn't mention this, but it should be a one-to-one relationship. Every bank account should have one cash account. You shouldn't have a one-to-many going either way. And as long as you maintain that and you're posting to the bank, everything should, in a perfect world, tie out. And you can imagine if it's a one-to-one relationship and you only do it on one side, you're never going to balance. Biggest rules, make sure that they're always tying out and they're always the same. If you turn direct posting off to your cash account and only post it through the bank account that's linked to a cash account, all your problems should technically be solved.
Okay, amazing. Thank you so much for those insights, Ben. So Matt, I am coming to you, and you are obviously going to offer very different perspective from the bank, and there are a lot of different security concerns that you need to worry about there. And by the way, Missy, I obviously want you to touch on the sweep accounts that Chris had mentioned, so you can probably detail there. And the other question I'm going to have for you, and I can probably repeat that question, once you have addressed these two, but I'll still offer that right now so that you have in the back of your mind. That is going to be, Ben mentioned that you are going to have just one-to-one relationship between your bank account as well as your cash account. Now, let's say if you have 10,000 employees and they all have each of their credit cards, and they are probably going to have 10,000 bank statements because they have, let's say if you are not doing based on your credit card. So are you going to have 10,000 chart of accounts, cash accounts, or are you going to be doing just one? So yeah, maybe you can offer insights there. Matt, over to you.
Absolutely. So I'll actually address that last part first for Ben's point. It's absolutely a one-to-one ratio, and you tie the credit cards that they're all posting from the same statement. So each card ending 1, 2, 3, 4 is still the same account as card ending 4, 5, 6, 7. This way, they're all together in that one chart of accounts. you can still then report into it a little further. I recommend that just be a memo line on your posting. So when that card gets swiped, it posts to the expense that you're going for, as well as that particular credit card account on your chart of accounts. So that's the offset entry. There, it's a memo line. You don't have to worry about the individual cards if you give out 1,000 cards to 1,000. To Chris's point about sweep accounts, I look at this completely holistically. So we're going to back up one step further before we even get into that. Your bank is a vendor. They are giving you services that are going to help your life. Select them accordingly. Because sweep accounts are really important. Number one, your cash flow. The bank doesn't care what your ledger tells you with your receivables and your payables. If the check didn't make it, if the EFT didn't show up, if the wire didn't show up, it's not there. And that's what I say what I would say as a banker. It's like, not on the statement, it never happened. If it's not in your bank statement, the bank does not care. It did not happen. So sweep accounts are really important because you might be expecting a wire from one customer that's going to cover a transaction on that account. You can sweep money from any of your other bank accounts. Those are just transactions. Guess what? They appear on your statement. They will post as different transfer type transactions. They're all going to post. Get that money cleared so that you're not drowning in overdraft fees because all you're doing is paying the bank money. That's an extra expense that's preventable. You can have the money sitting in any number of your accounts. Sweep them over. Use cash sweep accounts. Zero things out. Another thing that I always tell people to do as well with the chart of accounts on that, when you're using Positive Pay and any of those other services to track your checks, bank fraud occurs. If you have to change the bank account for whatever reason, you got to close out the account, open the next one. Also, close out that account on your chart of accounts and open the next one. That is the last time you use that number. So if your cash account number and it's, your number is 001, if you close it out, just make it -002 the next time. Start it so that the last entry on 001 is the closeout debit to that cash subledger, crediting the new one that's replacing it. And that's the memo line that links that. That is your transaction. It keeps things better because if you have to go back and discuss things with your bank 60, 90 days later, 120 days later, depending on the length of the investigation, it makes life easier for all parties because then you can sit and when you reconcile, this is the one place where no matter how much your ERP is your source of truth, the bank statement is an even better source of truth because the bank will tell you if it's not on the statement, it didn't happen. And if it's on the statement and you're disputing it, you're going to get the dispute adjustment resolution when that occurs.
Okay, so some very interesting insights there. So I definitely want some more colors there, and maybe my listeners would like, some more layers as well. Why are we sort of, closing the transaction, and why are we sort of increasing that again? So, provide maybe some sort of example there, so that we can follow along.
Absolutely. So transparency of detail. So I'm going to use an example that happened to me at the bank that I work for. It was a company's payroll account. All the paychecks get issued, and they still issued paper checks. Needless to say, when you have paper checks getting in the mail to different places, checks can get stolen. Now you have a routing number, you have a bank account number, you have all the information. Somebody used that information, started making purchases online. Positive Pay picked it up. We said, this transaction is being done. It's not a check that was issued on your payroll file that came over, so we know it's not this business account. We closed the account. We put it on FraudWatch. It was our recommendation based on what had happened from our fraud department that we close that particular account and open a new one reissuing number. So now all the checks are now invalid. They're reissued off the new account. But the way the bank statement is going to rectify that transaction is it's going to say closing transfer, we're closing account 1234. That account is closed. Let's say there's $10,000 left in it. We are taking that $10,000 out. We are opening a new account with $10,000. What I'm recommending is your ERP matches that exact same transaction flow so that your bank statement that shows this account is closed, taking out $10,000. This account is opened with a $10,000 opening deposit. You want your chart of accounts to match exactly that workflow so that you have to come back at tax time and say, what transactions hit? When did things get paid? Everything is the same on both sides. It makes your reconciliations that much easier. Good luck reconciling. And how do you deal with that transaction when the bank is telling you, no, this is two different accounts? It's part of maintaining that one-to-one ratio.
Okay, amazing insights there. So I think what Matt is trying to say is, mimic the real world. This we typically hear, in the manufacturing and the operations world. But it's very interesting to hear that from the banking perspective as well, that whatever happened from the bank perspective, make sure you have all of that replicated as part of your processes so that you have the complete traceability of your transaction when you are going to be reconciling that. Thank you so much, Matt, for that. Sharon, so I'm actually coming to you overall in terms of your perspective on the bank management processes that you have seen. From your perspective, obviously, you can offer any sort of commentary that you might have based on the comments that have been shared so far. Any sort of agreement, disagreement on the best practices.
My recommendation for small business owners who run e-commerce has multiple bank accounts for different purpose. You can open as many as you want, however, as little as possible. So you don't have that confusion. So the purpose of doing that is that you have an account for money inflow coming in, and then subdivide your cash to different purposes like tax, payrolls, inventory repurchase, or just general business fixed cost operation. So that you have a certain amount of money that allocated for different purpose. Doing that is that the reason I recommend this is because when you are running a inventory-based business, you have high season, low seasons, and sometimes you may come in a huge amount of cash coming to your bank account, and all of a sudden it's psychological. You feel so rich, and you start spending money buying new software and do this and do that, but you don't know that you don't have money. Like, that's not the money you should spend. And then in the end of the day, that you don't have enough money to buy inventory at all. It just kind of like all of a sudden you feel like you're so rich, and then another minute you feel you're so poor. So that's a way to psychologically help you to balance out everything. Yeah, and then do not try to move money from the payroll to the inventory purchasing and then to the tax and then shifting money around. I mean, once you make the decision, the percentage, what you want to spend on each category, try to maintain that as much as possible. So what happened is that when you don't have enough money to do things, that means you actually don't make enough profit, and you need to review your price or things of that nature. Yeah, I'm good.
Okay, so very interesting commentary there. So I'm going to have a follow-up question more related to inventory. And one of the problems that I have seen in my customer base, people sort of struggle when they are thinking of inventory versus bank accounts. And in a lot of businesses, I don't know, Sharon, whether you have seen this or not, but they are probably going to use credit cards for their inventory as well at times. And when they do that, the inventory does not really go through your ERP processes, and then that is not going to be accounted towards your cost of goods sold. And sometimes that is probably going to be as part of your expense. Okay, the way you are going to be buying inventory, because let's say an employee, a founder, or the owner, if they have the credit card, they might be buying, and sometimes they might not even tell that this is going to be an inventory that is actually going towards your product or towards sales. So how do you sort of handle these situations when this might be happening in some of these smaller businesses? Do you have any sort of recommendation there?
It will have a general rules, like say this credit card just for buying, inventory, and this credit card is just for, administration expense. Try to separate that so that you have a mindset like this is the purpose of it. You don't want to mix your credit card with inventory purchase and then, administration paying electricity bills, because in the end of the day, you want your bank reconciliation as simple as possible. You don't want to think or look back and say, oh, what did I do with this? Or what did I do with that? Bank reconciliation is so important, and you have to do it like at least once a month, and just keep it simple so you don't need to store any information in your head.
Yeah. So in my case, let's say if I'm using my credit card, I'm going to swipe whatever, and then I'll let my accountant figure out, what needs to be done, I guess. That's how most people do it. Thank you so much, Sharon, for that. Rachel, so I'm actually coming to you from your perspective. What have you seen when you think of any of the bank processes? What are sort of the boundaries of the bank account management processes? And if you have seen any sort of best practices there. Rachel, over to you.
Thanks, Sam. So I've been listening to everything everyone has been saying, and I just want to second and echo the importance of bank reconciliations. Yep. And really what that boils down to is controls, right? Controls, especially in large public companies that are highly regulated. I know we may not have an audience of people working in companies like that, but anyone who's come from a company like that or spent time in a company like that, controls are never anyone's favorite thing to do. It's kind of just checking all the boxes, making sure we double, triple checked everything, documenting everything, sometimes very copiously. And people sometimes feel bogged down by these controls. But when you think about cash control and bank reconciliations, it's so worthwhile to stay on top of your cash controls. If you are setting out to create a chart of accounts and you have bank accounts, it's so important to set yourself up to be able to reconcile, because cash is the engine of business, right? We need to know what's going on with our cash, whether it's because we need to operate our businesses or we need to comply with regulations, right? If we can't reconcile cash and we're audited, we're in a bad spot, right? So just good kind of financial cash hygiene, really, really important. Set up those subledger accounts so that you have a mechanism by which you can find discrepancies when you need to find them. If you don't have that mechanism, you're going to be spinning your wheels and you're not going to be able to understand your own cash position, right? And not only keeping the end in mind at the beginning, right? How you want to end up, how your control environment, how you want to end up when you're setting it up, but making sure that every single week, like clockwork, or every single month, whatever your cadence is, you are reconciling your accounts. You're staying on top of what's going on. And when you find that discrepancy, chase it down. Make sure you understand if there's a journal entry adjustment you have to make, if you have to call your bank and find out what's going on. Where's the cash? Where did it go? Stay on top of that cash. It's one of the most important things you can do for yourself as a small business owner and for your customers too.
Okay, amazing insights there. So I completely agree with whatever you said related to the cash hygiene. I think that is going to be super important. Also, your comment related to controls as well. So Rachel, what I want you to do is I want you to touch on this comment that Bob has asked, and I don't know if you agree with him or disagree with him. I'm going to read it for you. So he is trying to say, make sure you keep space in GL numbering scheme. I think he is touching on Matt's comment when he had mentioned that, you need to close your account. So here you are looking at slightly more, I don't call this intelligent, but maybe it is intelligent because you are sort of keeping them together to add accounts like Matt illustrated, as he's saying, so they don't appear out of order in reports. Do you agree, disagree? Do you have any sort of experience there?
I mean, I think that's just a very good intuitive idea, because you want to be able to look at an account and know where it belongs, know where it is. And anyone on the outside, and I'm always coming from the audit perspective because I'm doing controls reviews all the time, and I've been audited so many times myself. You don't want to create a situation where people are wondering, hey, what happened here? Why does this account look different than this account? What's going on? So appearances are, in many cases, almost as important as reality, right? When you're talking about audits and you're talking about keeping things organized, and just keeping things organized for yourself too in your head, you can very optically just look at an account number and know exactly where it belongs in your scheme. So keeping some flexibility in your chart of accounts and when you're setting it up, I think is a good idea.
Okay, amazing. Thank you so much for those insights. So Chris, I am coming back to you. So now we are going to do the story round, and everybody sort of, if you guys have any sort of story, and these are going to be examples from your experience, if you have any sort of horror stories of cash management, those are my personal favorite because obviously I'm here to have fun. So Chris, I mean, we are going to
I've got a good one. I've got a good one. But first, and Ben, thanks for reinforcing the GL thing. And I just want to make a couple more comments on that. And one of the entries we haven't mentioned that come in that's typically an external subledger is payroll. And everybody's booking payroll manually in their systems. And I think we go back to that best practice is how should you book it? Because most people just do a journal entry. And that's the perfect example. And they don't make an entry into bank rec. And what most people should do is the big, nasty, real complicated journal. It's a journal entry. But it hits payroll clearing, and up here you're hitting cash and payroll clearing, and that's your bank rec entry. And the reason you do that is because otherwise you have a gap. And somebody's fudging something and putting a sticky note that says why that 200,000 payroll entry is not over there. So there's a reason. So we go back to control, we go back to auditability, and complete your audit trail through the banking subledger. So that's the imperative there. And again, financial statements, you want to make sure that when you look at that number, you know, well, how much of that cash is equity? How much is mine, right? Different conversation. So here's the horror story. And again, the word we haven't said yet, or the phrase is separation of duties. And you think about in the lack of separation of duties, things happen. So we had an example where, and I discovered this for a client. They had me come in and do a little snooping, and we found about $384,000 had left their business. And the process that this individual was doing, and we're not going to name names, but there was no separation of duties. She was running payroll. in one of our favorite apps, right, Ben? Dynamics GP. So she's running payroll in Dynamics GP, and she's doing direct deposit. So she runs a payroll batch, adds a check for herself for, we'll start at 1,000, then she got brave, 1,500, 2,000, then she's paying her $4,000 a week extra. But she puts a check into the run, runs the process, generates the DD file, sends it off to the bank. Everything's good. She's getting paid. Then she goes and voids her check, deletes the DD file. Guess what? She's the one doing the bank rec. Nobody found anything.
Exactly.
This went on for a long time. And so you think about the guys, is how do you miss $384,000 in cash? And how do you reconcile and do year end and financials and all that? But it's separation of duties is really the key here. And that was $384,000. And I had another one, that another client, but again, signing checks. It got so brazen that she started signing the checks herself. And so again, she's catching the bank recs. She's doing the bank recs. She's fraud. And this is just very brazen. Started out with erase and redo, but then signing. And again, if she's catching the bank recs and then one day she's on vacation and the owner caught the bank rec and whoa, anyway, couple stories, but again, it's legit. And again, we talk about separation duties and controls. It's imperative that you really look at your processes. And I do that all the time. How can people steal from me? Okay, it's tough, but go through the exercise. Just make sure you vault, right? That's the word. Good story, huh?
Exactly. It's a great story, Chris, and I would definitely like to
People
have
are
your
scared
voice
now.
out
They're
and
like,
get
oh.
Exactly. Now, but I mean, see, I'm actually going to touch on your comment and on Rachel's comment as well. Okay. So obviously, when we talk about separation of duties and when we look at, accountants, obviously they are going to be completely separate. Nobody really checks their work unless they are getting audited. And we are talking about 80% of the business that are probably not getting audited. Okay. So obviously it is going to be up to the owners, how they handle their financials, because you can do whatever you want in the financial statements. It's a pure math if you really think about it, if you are not really having that audit like traceability, and that's why audit sort of exists. So let's say, Chris, if you had any sort of advice for the business owners, because when you look at the separation of duties, the accountants and the CFOs are going to have too much control. Obviously, if they make any mistakes, and they can always reconcile that. So what would be your best practice, let's say, if you're thinking more from owner perspective?
And again, this is the real reason that you move up to a little more mature ERPs, because they have the controls, and you can't, like the QB users, where they can delete an entry and it ripples through and it's gone. Everybody's like, what happened? You can fix stuff. No, you don't want to fix stuff. You want to put a correcting entry in there. But I think part of that is, from an owner's, is have confidence that any entry that's booked into your system can't be removed. Can't be removed programmatically, backdoor, SOC compliance. But again, that's the first thing. Make sure that any entry is booked. And I think the other thing is you need to look at some of the reporting. And again, from a bank rec, what we're talking about is someone that's processing payroll and doing accounts payable, where they're actually selecting people, cutting checks, getting checks signed, and then they're controlling the bank rec. There's got to be a separation between the money's out and looking at that bank rec. Or, if you're an owner and you don't want to do it, have it presented in front of you and have enough savvy to be able to look at it, or get somebody else to look at it. And I think that's part of it, is you can't be too hands off. And when it comes to banking and cash management, I think the other thing is to ask for the triangulation of reconciling your balance sheet, because you go back to, hey, start with the cash. That's the first thing you reconcile. He said it's the easiest thing. That's the first number you can prove out. Look at the bank account. There it is. What's outstanding? Okay, that's the first number you get, and then you got to go back and do your AR, your AP, and inventory, and say, well, what's my equity? Kind of ties back out to the P&L, guys, if you don't know that, how the balance of that equation. But understanding that accounting formula and being able to look at it, and just, it's simple math. It really is addition, subtraction. But, and get somebody to help you if you don't know how. But you can spot check, and again, things can
the insight there. Thank you so much for that. So, Ben, I'm actually coming to you, for your story or any comments that you are going to have so far based on the comments that have been.
Yeah, I've got a story that actually goes off of something Rachel brought up, kind of like the don't let discrepancies go. But before getting to that, wanted to talk something that Chris had mentioned, right? He was talking payroll entry, which I agree. Pretty much every client out there is doing it manually unless they have an in, which I always recommend to my clients, build a payroll integration. And nobody wants to do it because it costs some money to build it, right? But then my next question to them is, when are you going to stop running payroll? Their answer is never. Well, if you're never going to stop running payroll, why? That means you're going to do it manually forever. So why not spend some money and, bulk it up? And if you're a technology company, right, and there truly isn't a payroll integration for the tool you're using, and it's a well-known tool, there's probably like 5 or 6 like really I would consider good payroll tools out there. A lot of them integrate to some systems but not others, right? Look at the market opportunity to build the integration. I mean, I don't want to take business away from what I'm doing, but there's a lot of opportunity out there to build these things, right? And I've built one with my ERP that didn't exist previously, and it saves all of my clients using the specific payroll tool and the specific ERP a lot of time. So I'll get off of that track, but kind of leads into what Rachel said, right? Don't let discrepancies go. And this is where my story comes in. I have a client who, like every client, typically people don't want to spend the money to be proactive. And what I like to say is, everybody knows that interest compounds, right? If I could make 1% a day on my money for the rest of my life, at that compounding rate, you'd have unlimited money. Problems compound the same way. If your problems get 1% greater every single day, after 365 days, you're going to have so many problems at the end of the, because things just get worse and worse, right? So if you let one little discrepancy go, typically you'll have a tendency to let the next one go. And then at the end of the month, you'll have so many discrepancies that you can't close your books in time. So you'll let them go to the next month. Then by the time the end of the year rolls around, you got so many things you got to hire somebody to do, right? So I ran into a situation exactly like this a couple months ago. We started in June. They hadn't reconciled anything. And it took us, from a dollar standpoint, it took us probably a little bit over $20,000 to reconcile literally every single thing they needed in their system. Going forward, we now have a contract in place that they spend about $1,500 a month for us to proactively manage it. So after 3 months, they're spending about a fourth of what we spent to fix it. So in practice, just goes to show, again, yes, it's money that you have to spend to be proactive. People don't want the cash flow that we talked about last time to go out now. They would rather have it come out later. But if you compare what the later cost is to delaying it to what the proactive cost is, I always think that the proactive approach is obviously the sound decision. And again, if you let your problems go, they're going to compound. And again, I think the proactive approach is always better than the reactive. And if you're using something like QuickBooks or whatever, and you can delete entries, it makes it even harder. I always suggest audit trails, which a lot of modern ERPs have. So instead of deleting, you should just see reversals or negatives to what you originally booked, and it helps your audit and your CPA take a look at your books, which is something else we haven't really talked about. But if you're getting audited, audits can be very, very expensive. The better your data is, you're going to have to spend money on the audit no matter what, but the better your data is, the cheaper the audit's going to be, because the less the auditors have to look through. So again, all these proactive things you can do can make a lot of things in the future a lot cheaper if you're set up correctly.
Okay, so very interesting story in the insights there, Ben. So the follow-up question I'm going to have for you in your industries, obviously, some of the projects that these industries are going to do, they are going to be very long-standing in general. So when you look at these companies that are going to have long-standing projects, do they have any sort of best practices when it comes to managing the cash? Do they typically do one chart of account per project? How do they sort of think about the bank account versus the larger projects that are going to go for many months, many years?
What do you mean by the larger projects, like for project accounting specifically, or how to set up ERP during a project?
Yeah, so let's say you are in the professional services space, so there you are going to have the revenue coming in, every month, and that's going to have the whole project. So obviously that needs to be reconciled with your cash or bank account. So are there any sort of best practices there in terms of how you are going to be mapping your bank accounts, or is it just generic that okay, it's one-to-one mapping based on your bank account and cash account, and then you can figure out where you are paying and reconcile that with them?
Yeah, I think that opens up probably another can of worms when we get into revenue recognition and that kind of thing,
Exactly.
right? Like when you're looking at banking, kind of like Matt said, like the bank doesn't care about how much revenue you have, how much expenses you have if no cash has happened, right? So in accrual accounting versus cash accounting, right? Cash is king. That's all the bank cares about. If you got it, you got it. If you don't, you don't. And I think revenue recognition from like a project standpoint, right? If I sold $100,000 project today and somebody paid me $100,000, well, in that case, I've got the cash, but I don't have any revenue yet. At least I shouldn't, because I haven't performed any obligations to recognize revenue in that case. So that probably is honestly another good 1 hour discussion, Sam, on revenue recognition and kind of how everything really recognition versus banking and cash. To me, they're two complete separate things. At the end of the day, when the cash comes in, you got to apply it to something. It's either an open invoice, or if it's a prepayment, then make the entries to then apply it to future revenue activities and invoices and things like that. But to me, those are truly separate.
Okay, amazing insights there. We'll do that session another time. Thank you so much, Ben, for that.
Sounds good.
So, Matt, I am coming to you for your story, and your story is going to be probably even more interesting from the bank perspective, I guess. You're on mute, Matt.
Thanks for the notice on that. So, great point to what Ben said about like accrual accounting and all. To me, easiest entry there is. The cash is debited against your cash account because you have the money on hand. The offsetting credit, the offsetting credit, because we're debiting the cash account. The offsetting credit's a liability account. You haven't accrued it yet. Just have a liability for work pending, project pending. Then, as the bank account drops, you're dropping that liability into the proper income accounts when you're recognizing it if you've spent that money on other services. Easy enough. To Chris's point earlier about separation of duties, once you grow past, there's actually the next step on that, which is that you eventually, if you grow to the point that you are so large where not only are the duties incredibly separated, you start getting double sign-offs on things. You have somebody else look over two people do things together. Because if two people are doing things together, it becomes that much harder because eventually that's what's needed. So you grow it to that point. It's a great point. That's step one. Step two is going to the next point. From there, managing your bank accounts is just, it's in and of itself its own adventure. And that is something that you have to stay on because, again, as we said, banks don't care. Cash is king. We've been repeating that theme the whole way through. And in that so much, you should know what all the entries are coming into it. Offsetting accounts are very important on the liability side for the accrual because you are going to have cash deposits. Project accounting is a whole other animal. That's one that I don't even like tackling because it's so anatomically different to what banks will do because a bank says it's one account, it's one thing. And project accounting is not that. So like, that's actually what I'll sit as an audience member for that. Because I'd be interested to see what other people say. To what we're saying though, it's all about tracking. And this is the control. And in some ways, the bank is forcing the control on you because the bank statement is the statement of record and is a statement generated by the bank with you having no input on it. So they are handing you something that is your control document that is completely made by a disinterested party because the bank doesn't. So they're handing you something. The biggest story about tracking cash, though, that comes in out of this is always knowing post and EFTs, anything that has delays on it. That's the other way. I've already done the service. I'm getting paid on completion. That doesn't matter. If you missed the cutoff time for the day, so the bank that I work for, international transactions cut off at 2:00 in the afternoon, Eastern, 6 p.m. for domestic. Well, cool, you finished that work, but if the wire didn't hit their queue before 2, it's going on the next day. You don't have that cash. It's not in your books. That's a discrepancy that's going to show up potentially on your ledger. That's something you got to reconcile out. Now, most of the time, it's just an adjustment, pending, not booked. Oh, by the way, we have holidays coming up. We just had Labor Day. Labor Day was always, any of the holidays on a Monday were always a fun one for me as a banker because every Friday I'd be, telling everybody, this is Tuesday now. We're on Tuesday's banking day, not Monday, Tuesday. You got a weekend. Christmas and New Year's being a week apart, it's the same thing. Oh, you have a transaction that's going to take 5-6 days to fully book on the bank side. Guess what? It may be 5 or 6 business days, but with Christmas and New Year's in there, you got Christmas Eve, New Year's Eve too. Depending on how weekends fall, when Christmas appears on a holiday, that might be 2 weeks all of a sudden. And we're not just talking about, this could be the difference between a transaction appearing on December 22nd, could be January 3rd, 4th, 5th, 6th. Oh no, we're booking 2 separate calendar years. Control that. And that is something that I really get on people about. Select a bank who will process the transactions in a way that can be transparent to you. A bank is a vendor in this case. Treat them as such. Vet your bank like a vendor. If you don't like how the bank books your statement, shop around other banks. You will find somebody that will either give you clear instruction about how they're going to book. Paper checks are another one. You deposit a paper check, there's a clearing time. You put it in. You may have booked the deposit, handed it to me on a day, but that bank might not clear that check for 2, 3, 4 days. By the way, banks can hold the check for 6 days. No questions asked. They don't have to do anything. They can just say we're holding it. They don't have to clear it. So know those things. Talk to your bank. Your banker should become one of your best friends because the first time you see a discrepancy, that's the first phone call. It's insurance. We pay for car insurance because we don't want to use it, but we have it. Health insurance, we have it. We don't want to use it. All of these bank services, all the things that Ben was talking about, it's insurance against the bigger thing. The claim is paid because you don't need a $20,000 audit. You paid a little bit up front. You had it taken care of.
Okay, so some very interesting insights there. And I especially liked your comment related to researching on how banks are going to be printing these statements. And the reason for that is the way they are going to do is it's going to impact your operational workflow. So let's say if they break out all of those transactions, then you are probably going to be matching a lot more. And the same thing goes for scenarios such as when you mentioned two people signing off on a project. So sometimes what may happen, and I am sort of going back to my example that I had mentioned, when you have 10,000 employees, you might have 10,000 different cash accounts, but then sometimes you might have just one transaction in each of those accounts. So you are going to be thinking, you know what, let's just lump everything together, because you are probably going to have one entry and you don't really have as much reconciliation. So I'm simply going to create one account and going to be matching with each of them so that I don't have the maintenance overhead of those 10,000 cash accounts that I need to maintain in my chart of accounts, right? So sometimes when you are going to be thinking about these decisions, you have to think of how this is going to impact other departments, how this is going to impact the operational workflow of everybody else who is going to be touching these transactions. So unless you have done this 5,000 times, it's going to be really hard for you to be able to visualize. You are going to make it simple. Let's do it. It's logical. But it's not going to be logical when you are actually analyzing the complete workflow. So, Matt, I don't know if you have any sort of follow-up commentary there based on my comments.
Absolutely. And the answer is it's a cost-benefit analysis. Every one of those options has a benefit, which is the simplicity of the reporting or posting, and a cost, the time it takes for you to do it. So what I would always recommend, and this is the thing about now being a former banker, is active banker, I'm going to tell you to open 10,000 accounts. It's in my best interest to have that happen because that's one of the things that we're graded on. ERP analyst, well, now I'm telling you to use as few as possible. But there are certain things you should always separate. I recommend separating payroll. I recommend separating merchant clearing accounts if you take credit card payments. So if you're somebody who takes credit cards, separate your merchant clearing account. You don't want to be dealing with that if a Reg E claim comes in the other way. Have a savings account is the final thing that I would say at minimum there. The reason for that is, A, the savings account acts as your sweep account. It can fulfill balances for any of your payables if something else hasn't cleared along the way. B, earn a little interest for yourself along the way. Even earning 0.5% interest, if that's what the rate happens to be, and we know rates have been low before they started raising, 0.5% is better than nothing. Make your money work for you while you have that cash. Make the cash that you had as a deposit on a project work for you while you're holding it. That's extra income. Make it work for you because that interest, that's yours.
Amazing insights there. Thank you so much, Matt, for that. So Sharon, I'm coming to you. Your story, please.
Again, I echo everyone's comment here that the check and balance, that if you have a separate account, again, like if you have employee using your credit card or debit card, and there's a limit on that. So if there's money missing or mismanaged, is a way to stop it, change the card number or things like that. It's easy to manage instead of everything on account.
Okay, amazing insights there. So in that example that you are trying to mention, so I don't know if you're going to have some more colors there so that people can follow along. So are you suggesting that, let's say, if they are going to hit the limit, should they be increasing the limit? Should they be using another employee's card? Or how are you going to manage the situation when you are going to be hitting the limit, let's say, on the credit card? Sharon.
I would say it depends on the job function. Like I say, if the salesperson has to go out, dinner, wine and dine their clients to get the business, then you say, okay, you are allowed to spend like $300 a night, and then you're going out maybe 3 nights a week, and you just, proportionally is thinking maybe $1,000 a week, so that credit card should have, I don't know, like 4,000, 5,000 limits, so that, in the month that you pay off that credit card without go over the credit card limit.
Okay, amazing. Thank you so much, Sharon, for that. So Rachel, I'm actually coming to you for your story. You're on mute.
Yeah, sorry. We could be here for days with all the stories that I have. I'm going to try to pick a couple that I think illustrate some important points. One of the stories I have is almost an exact replica of Chris's story. I actually worked somewhere where my predecessor had control over payroll, and it was a small business, so there were inadequate segregation of duties. There was inadequate segregation of duties, and she was in charge of running the payroll and reconciling the payroll to the bank. And she just created ghost employees, or when employees termed, she just redirected their bank information to her own account. And nobody noticed until she went on vacation. And I remember my boss telling me that she would have nightmares. I mean, she was traumatized by this. She had nightmares for over a year about this woman. It was terrible. But again, the importance of segregation of duties surfaces again, right? And from a controls perspective, in an ideal world, if you can segregate the movement of cash from the approval of any cash out, any expenses, from the reconciliation, all those three things, that's wonderful. But especially the movement of cash, the ultimate review of that bank statement, right? As a business owner, you have to own it, right? You've got to know where your cash is going. Your neck is on the line at the end of the day. So you've got to be looking at those bank statements. So that's one story. Another story is actually out of the news recently. And it hits home a little bit me because it's someone in my community, but there was an executive director of a private school who stole, I think, over a 20-year career, $8 million because he was the only one in this school with any level of financial sophistication. He made sure that he was the one reconciling. The reason it happened has to be that nobody else was looking at the cash account versus the books and records, right? The actual bank record, which is an agnostic, completely, independent view of what's actually in the bank. The bank doesn't care. We keep saying it over and over. That's your corroborating evidence, right? And if only one person is looking at that person has a lot of power. You don't want to give anyone that power, right? You want to make sure that as a business owner, you know what's going on. So those are the stories.
Yeah, very interesting story. So obviously you do a lot of coaching, Rachel, in your business about how to do the control in a business. Mm-hmm. So when do you think business owners should be thinking of putting these controls? Do you have any sort of ballpark? Is it going to be like $1 million? Is it going to be $5 million? Is it going to be 20 employees, 50 employees? When should the problem is going to be so unmanageable that they should probably do something about it?
So I always recommend don't ever let yourself get to that point, right? I'm a controls person, so I'm a little biased, but I'm going to say you have $1 of revenue, you should have some controls, right? Set it up at the beginning. Again, that good cash hygiene. Get yourself used to this. Have discipline in managing your cash. You don't want people stealing with you. There are so many stealing from you. There are so many unpleasant things that come along with that. Not just the controls attribute, but it's terrible, right? This is something that should be kind of like the equivalent of brushing your teeth in your small business, right? You do it every day. You make sure that you set things up so that you know what your cash position is on a recurring basis. As your business grows, you may want to look at it more often. You may want to involve some other people in helping you out. But if you can separate, that the approval and the movement of cash, if you're not doing it yourself, from the reconciliation right away, do it as soon as you can.
Okay, amazing insights there. Thank you so much, Rachel, for that. So now we are going to take just closing advice. Just one word, please. Everybody, you can keep yourself on mute if you like. Chris, one word closing advice, please.
One word. Keep the cash under your eyes. Don't let anybody else do it for you.
Amazing. Love it. Thank you so much, Chris. Ben, one word closing advice.
I think Chris had more than one word, but I'll go with one word. Reconcile.
Okay, amazing. Love it. Thank you so much, Ben, for that. Matt, closing advice, please.
Controls. Audit them. Audit.
Love it. Thank you so much, Matt, for that. Sharon, closing advice, please.
Know your numbers. Breathe and sleep with your numbers, so you don't feel you feel it. If something is off, it is off.
Love it. Thank you so much, Sharon, for that. Rachel, your closing advice, please.
You're muted.
Sorry, more than one word, but take it personally. It's personal. It's your cash.
Love it. Could not agree more. Thank you so much, Rachel, for that. So that's it for today. If you joined for the first time, this was part of our digital transformation. Every Thursday at 5:30 Eastern, we pick one topic related to digital transformation. So make sure you guys are going to be here next week. We're going to come back with another topic. On that note, thanks everyone for tuning in tonight.
Thanks, everybody. Good seeing you all.
Thanks, everybody.
Have a good night.
Bye.
I cannot thank our guests enough for coming on the show, for sharing their knowledge and journey. I always pick up learnings from our guests, and hopefully you learned something new today. If you want to learn more about Rachel Capel, head over to eventusag.com. It's eventusag.com. If you want to learn more about Chris Garadini, head over to turnkeytech.com. It's turnkeytech.com. If you want to learn more about Matt Bernard, head over to striven.com. It's striven.com. If you want to learn more about Ben Cole, head over to erpconnectconsulting.com. It's ERPCONNECTCONSULTING.com. If you want to learn more about Sharon Custer, head over to inventoryoptimization.pro. It's INVENTORYOPTMIZATION.pro. Links and more information will also be available in the show notes. If anything in this podcast resonated with you and your business, you might want to check other related episodes, including the interview with Matt Bernat, who shares his insights into the nuances of bank integrations and considerations for ERP buyers. Also, the interview with Abu Asif, who shares his insights into the processes of cannabis business in Canada. Also, don't forget to subscribe and spread the word among folks with similar backgrounds. If you have any questions or comments about the show, please review and rate us on your favorite podcasting platform or DM me on any social channels. I'll try my best to respond personally and make sure you get help. Thank you, and I hope to catch you on the next episode of the WBS Podcast.
Thank you for listening to another episode of the WBS Podcast. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. For more information on growth strategies for SMBs using ERP and digital transformation, check out our community at WBS.rocks. We'll see you next time.